Okay, during this class, we're going to talk about supply, short positions, gaps, and pulling it all together in a run phase manner. Why is Microsoft, Apple, ES, or the S&P 500 and all this market continuing to going up, 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 and not crashing like everybody says? This is the question of the century, as we are in one of the greatest short squeezes the market has ever seen. And yet nobody talks about it. Why doesn't nobody talk about it? Because they don't understand the business model of wholesale. They don't know what type of market they're in. And so we're going to pull it all together in this class. We know that the market is always seeking a place where business can be conducted, where buyers and sellers can transact with ease, where buyers buy the low and sellers sell the high, and it comes out to be a balanced market. And this is known as your auction range. And it doesn't matter what market you're in. This is the objective and the goals. You could be selling fish, Nikes, stocks, caskets, whatever. Then we come to the edge of balance. Well, whether it's up or down, like you see in the charts where you have passive buyers and passive sellers. However, when it gets high, and instead of rotating back down, buyers become aggressive. And then the seesaw that they're on becomes imbalanced. And aggressive buyers start to push it outside of that balance. And those aggressive buyers are what we are talking about here. And now, for whatever reason, people think because the RSI or the news or whoever says it, whatever plants it in your mind that the market is too high, so they think it's time to crash. It has to crash. It has to correct. It doesn't have to do that. So listen, now we're going to talk about this chart right here. So when the market is trading at a trading range, then it gets to a level, maybe a level has never been traded at before, like we see in the ES right now, or a level higher than the trading range was. And, people think that it's too high, so the market dips and people short it. And then when it dips a second time, instead of shorts closing their positions, they add more shorts to their positions. And then the gap happens, right? So what is all this, right? So let's break it down to steps. People short the market, and we know that a short position is selling something that you don't own, and you buy it back at a cheaper price and collect what's in between, right? And we know that we are in a market gathering, an asset gathering market right now, which means the bigger institutions are getting paid to hold on to their shares of Apple and Microsoft and whatever, which is forcing momentum traders into this market, because why would institutions come and buy and sell stuff at this level? So when the market gets to a level where people think it has to crash or correct or it's too high or whatever their theories are on why the market needs to come down, they short it. And the people who actually own the product have no intentions to sell at this level. So it traps the shorts below the gap, and then the gap is buy orders that can't get filled because supply has shut off, because the people who own the product have no intentions of selling the product. I say again, I say again, I say again, right? People have shorted what they don't own under that area, and above that gap, people who own it have no intentions of selling the product to them. So a gap is buy orders that cannot be filled. Same with single prints to the upside, right? So if you know the business model of the industry, and with people who have lots of money, they don't short sell at all. Short sells are for people that have smaller accounts, from people who hedge with speculative money, aka credit. There's no interest rates, and they have taken a macro fundamental view of shorting for some reason, And they are ignoring the facts that there is no supply and there is $8 billion borrowed against equities portfolios to play with. What is happening in the ES isn't manipulation. It is the ES and the S&P 500 and Microsoft and Apple, they're not penny stocks. What is happening is supply shuts off in an area where people own the product that have no intentions to sell. So sure, like gaps do you fill? Can you afford to be short the amount of time it might take that gap to be filled? What fills gaps is overhanging supply. Supply fills gaps, right? So if we had an outside seller, aka these institutions, sell their positions, then that would open up supply, right? Overhanging supply is a minute amount of supply that is introduced into the market right now. And it is the momentum size traders and prop firms bullying each other around with the account. That's why overhanging supply corrects, right? So you have to have longs sell their positions to fill the gap. And this opens the supply for the short position traders to close a position. If the bigger firms who are holding a million gazillion shares of stocks aren't selling their shares, why would we? So quick recap of what we talked about. The market is operating on a huge short position, which leads to the market going higher because there is no supply. Why is there no supply? Because it is an asset gathering and management market. What does that mean? BlackRock gets paid an annual percentage to hold the billion shares of Apple that they own, for example. So momentum traders and prop firms are the only ones in the market right now, and they are operating off of hella credit. And because they are operating off of hella credit, they're having a war against each other and pushing each other around to make the other one puke up their supply. Whoever has the bigger account wins. Whoever has the smaller account sells, closes their position. And when they close their position, it may lead to T+2 margin calls, and then people keep shorting the hell out of the market because this is the big crash and don't cover. They add to, leading the market to rip even more. Why? Because there's enough supply. The only supply comes from short-time longs who sell due to no upside. The reason the ranges of the corrections are massive are because it is costing less money to bully this market around, and there's no trading range because the institutions are not in it. And right now, let's say BlackRock wants to sell some of the billion shares of Apple that they own. They couldn't even if they wanted to, because if you look at the float versus the 10-day volume average, is like 0.5% liquidity for them to sell it to. So why would they sell some when they have no interest rates and they're getting paid to manage their shares? Which is why it's important to play what's in front of you, level to level, and leave all biases of the market at the bar. Do not confuse what is happening in the ES with manipulation, like I taught in the Bobo and Tuna manipulation class in the business model of wholesale. In the walk version of this, we talked about, how market makers can manipulate price with a stock, but that is not what's happening with ES. Hopefully this helps, guys, and I hope you got a lot out of it.